Chapter 18, To Infinity and Beyond. Where is this all going? Is it possible that we've already reached capacity in terms of scalability and it's just a matter of time before all the altcoins max out in terms of transactions processed per block, just as Bitcoin did in December 2017? In this vision of the future, there is no Facebook-like single currency that takes over the whole world, leaving no competitors, although Bitcoin maximalists will say otherwise. Instead, it's just a matter of each currency attaining a maximum value given its block space, transaction capacity, and mining fee pricing. In this case, it becomes a multi-currency world which requires converting to different currencies to complete transactions, and valuations for each currency will attain a maximum stable value that makes transacting less risk exposed to currency fluctuations. These currencies may be interlinked via atomic swaps, making swapping between currencies almost seamless. Combining this technology with currency mixers and a more anonymous version of Shapeshift.io will also make it harder to track transaction data as transactions skip from blockchain to blockchain. Likewise, given that technology is often an arms race, the near future is likely to see developments in the transaction tracking space. Governments are likely to be compelled to develop more and more sophisticated tools for determining the identities of market participants. Called cryptoanalysis, this new field will provide a lifeline to tax-collecting organizations like the IRS that stand to be the biggest losers in the blockchain revolution as an increasing volume of financial transactions moves into the pseudonymous cryptocurrency space. This, of course, is one of the major instigators for Monero and Zcash-style privacy coins. In fact, Amazon has already patented a software that allows it to utilize online identity data like names, emails, and physical addresses to link identities to cryptocurrency addresses. They will presumably license this software to government agencies for use tracking online financial activity and tax exposure. There is also increasing interest from the traditional players in the financial industry, like banks and hedge funds, who are beginning to understand the revolutionary nature of cryptocurrency. While in previous years it was just the venture capital firms that were taking bets on new blockchain ventures, more and more, larger and larger institutions are realizing that small bets in cryptocurrency can pay off tenfold provided one has the courage to stay in the market. Large investors like George Soros have established cryptocurrency trading desks, while other big financial players like Fidelity have established trading platforms as preliminary routes to gain limited exposure to the cryptocurrency space. As the asset class gains more prestige and credibility, this exposure is only likely to increase. We will know that cryptocurrency has gone mainstream when your bank shows you the balances of your cryptocurrency assets alongside your bank balances in your monthly statement. Another step in the legitimization of cryptocurrency is the establishment of currency ETFs that allow ordinary share investors to easily diversify their portfolios into cryptocurrency within their already established share trading accounts. This will likely facilitate the injection of significant amounts of capital that previously were unable to access such high-risk assets or unable to get over the technological barriers that stood in the way, mainly confusion about how to buy and correctly store the asset. Following ETFs, countries may follow. Everyone likes to make money, and a decade of exponential growth is difficult to ignore. In fact, by virtue of organized crime asset seizures, a number of countries have already made significant gains for their bottom line. There are unverified claims that Bulgaria was in possession of over $3 billion in Bitcoin that it had seized during the course of a criminal investigation. It's not inconceivable to envision certain jurisdictions choosing to diversify at least a portion of their assets held as foreign and precious metal reserves into cryptocurrencies as a hedge against future global developments in the finance industry. And in a competitive world where every country is watching what their neighbors do, it isn't inconceivable to see this leading to a gold rush as more and more nations seek to not be left behind as the price of cryptocurrency assets continues to skyrocket exponentially in the face of unchecked demand and finite supplies. The next logical step would be monetization or demonetization, depending on one's perspective. Japan was the first country to legalize cryptocurrency as legal tender, and this turbocharged the domestic industry as more and more retail institutions started to experiment with accepting cryptocurrencies as a legal means of payment. While some countries are likely to crack down on cryptocurrencies, others are likely to follow Japan's lead with a desire of attracting more financial innovation and investment to their own shores. More like the colonial era, the spirit of competition will drive countries to develop legal infrastructures that ensure that they won't be left in the financial dark ages. The real question that then again arises is, what is the upper limit for the market capitalization of cryptocurrencies? Is it the market capitalization of the global gold supply, $8 trillion? Is it the global supply of money, $83 trillion? What is the natural fair price of a digital asset that cannot be confiscated, and will cryptocurrency prices eventually reach a long-term equilibrium? The phrase safe as houses came about for a reason. Originally termed as safe as the Bank of England in the 1820s, the expression transformed during the railway investment mania of the 1840s that bankrupted many individuals in Victorian England. It referred to the comparative stability of real estate as an investment when compared to more speculative assets. Is it possible that the recognized utility of cryptocurrency could one day surpass the perceived utility of the entire real estate stock of the whole world? In many ways, it does make sense from the perspective of it being more liquid, not susceptible to confiscation, easily transferable globally, and easy to secure and spend. Is it possible that there may be a point in the future where we start to say safe as crypto? This quite possibly could be the paradigm that we are entering, but only time will tell. This is a question that can only be answered by the passage of time and people's changing psychological perspective on what constitutes real value. It doesn't take a stretch of the imagination to recognize that there must have been a time when precious metals like gold and silver weren't viewed as having any particular precious value, but that psychological perception of value built over time as there was more and more agreement as societies revered these precious metals more and more. And then there's the question of the environmental sustainability of blockchains. As mentioned in previous chapters, the electricity consumption of blockchains is a problem. As the price of Bitcoin increases, the revenue from the block reward increases, and the potential for miners to increase their cost base also increases. This means miners can invest more money in mining rigs and spend more money on electricity in order to increase their chances of solving future blocks and winning the associated block reward as a direct result. As mentioned, this has been an environmental disaster, and various journalists have made predictions that given the current rate of increase, Bitcoin will be consuming the whole world's electricity in a few years. This logic is fallacious. It is akin to drawing a straight line graph of a pregnant woman's size against time after the first 3 months of pregnancy. If she keeps on growing at this rate, she will be 400% bigger in 2 years. It also does not take into consideration the block reward halving. Every 4 years, the block reward that miners receive every 10 minutes is programmed to halve. This means that unless the price of Bitcoin at least doubles, the miners' revenue will halve. What this means is that while the revenue from mining is currently increasing every year in tandem with the increase in price, eventually mining revenue will peak and then decrease as the increase in price is proportionately less than the decrease in the mining reward every 4 years. The mining reward is programmed to reach zero in the year 2140, by which time transaction fees will be the only way miners receive revenue for solving blocks. Hashing one transaction requires the same amount of power it takes to hash 1 million transactions. Thus, provided that transactions aren't competing for block space, as is currently the case for BTC but not for BCH or BSV, users won't be forced to increase the cost of their transaction fees in order to outbid other users so they can get on the next block. This means that conversely, there could conceivably be a race to the bottom where miners are competing against each other to produce the next block using the least amount of electricity, in which case the amount of electricity consumed will decrease considerably. Whether this happens quickly enough remains to be seen. Commentators like to compare the price of cryptocurrencies, in particular Bitcoin, to tulips. This refers to the tulip craze that swept Holland in 1637, when the price of a viceroy tulip cost as much as 5 times the average house price at the time. One major reason to doubt this analogy is the fact that the Bitcoin bubble has continued to inflate and deflate for more than a decade. If cryptocurrency is a passing phenomenon, it's difficult to see how it could consistently lead to such repetitive speculative bubbles. However, perhaps given the transaction cost increases and scalability bottlenecks, this time is different. Cryptocurrency has come to a very permanent fork in the road, and how the technology will develop from this point on is likely to influence the possibility of any new bubble in the medium to long-term future. Since its naissance in 2009, blockchain technology has come a long way, from being a fringe hobby project for the cypherpunks and libertarian communities, and being considered almost a joke, to becoming a multi-billion-dollar industry that has attracted tremendous amounts of investment and interest from governments, the finance industry, and Silicon Valley. However, despite the insane hype cycles that drive fantastic valuation bubbles, there are still surprisingly few practical applications that are actually using the technology in a constructive way to really make a difference. Nevertheless, the promise of blockchains to completely disrupt the traditional economic system has not been completely extinguished, as hundreds of engineers work on solutions to the scaling problems that have hampered the growth of the technology, particularly in the case of Bitcoin and Ethereum. Market watchers and participants will be eagerly observing the progress of the competing scaling solutions, like the Lightning Network for Bitcoin, Big Blocks for Bitcoin Cash and Bitcoin SV, Proof of Stake for Ethereum, centralization for Ripple, decentralized acyclic graph solutions as used by IOTA, or some as yet undiscovered method that current blockchain solutions just inspire. Unfortunately, this means for investors, picking the winner is not nearly as simple as it was in the early Bitcoin days, as now, instead of 90% of the market being occupied by one currency, thousands of currencies are vying for the cryptocurrency crown, so investing resembles a roulette wheel rather than the sure thing it used to be. So while the first decade of blockchain has been a frenzy of unbounded speculation that didn't require sufficient proof of concept, the next stage will undoubtedly require technologies to prove their viability if we are to progress from the current level of adoption and development. Only time will tell. Acknowledgements. Writing a book is no easy undertaking, and it would never get done without the various friends and colleagues that contribute their time and effort in helping the project reach completion. While there are countless people that I'd like to thank, in particular, I'd like to acknowledge my family for keeping my nose to the grindstone. Also, special thanks to Philippe Thenussen for reviewing early drafts and suggesting additional topics that added depth to the content. Xiaoyao Lu for his fantastic illustrations, Jocelyn Jaurès for his work on the front cover, Yannick Renaud for instigating many hours of reflection on the state of cryptocurrency markets, Dale Dickens for opening my eyes to the inner workings of the block size debate, and members of Crypto VIP, my cryptocurrency chat group of peers, who suggested countless improvements that added value to the end product. This book is dedicated to my wife, Yuhua Gu, who pushed me to put my knowledge on paper.